Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. First off, there's been some interest in discussing things outside of Canadian real estate and Vancouver real estate. So starting Monday, we're going to begin doing what's called a Macro Monday show. It's basically a macroeconomic focus, more outside of Canadian real estate, things, trends, topics that I'm watching. We'll continue to do this regular Saturday Canadian real estate show. We're also going to add on the Macro Monday show, where we're going to discuss things outside of that. So if you're interested in that, keep an eye out for that. But other than that, a huge news week to dive into. So this video might get a little bit more in depth, but a lot of things to run through. Like I said, a lot of large news flows coming through that I think are worth discussing. First off, to start the week, a lot of the big banks reporting their Q1 earnings. And I think, for the most part, those largely disappointed to the downside. You had, I think, Laurentian Bank reporting big net income loss year over year. But I think the big things is RBC, TD, and CIBC, arguably your three largest Canadian banks, reported not only disappointing earnings reports, but I think an interesting phenomenon is just to see their increase in loan loss provisions. So you had CIBC nearly double their loan loss provisions. So loan loss provisions are essentially the banks allocating a certain percentage of dollars to account for bad loans coming down the pipe. And so this basically is the bank saying, okay, based on the current conditions, based on what we're seeing in the market and in our loan book, we feel there's going to be an increase in bad loans. Let's allocate a certain percentage towards that. So you had CIBC basically double their loan loss provisions. RBC, the gold standard of banking, they reported positive earnings, but increased their loan loss provisions by just over 50%. And similar thing with TD, increasing loan loss provisions by about 23-24%. So what this basically tells me is the banks are sort of forecasting. The banks are basically telling you, or telling the market, that this is how they are perceiving the market and the credit conditions that are basically starting to deteriorate. Obviously coming off a low base, but that's just how they perceive it. So if you think that the banks are tight today, based on their increasing loan loss provisions, this only suggests that they're likely to continue to tighten from here, to continue to stress a significant oversight in terms of mortgage lending. So despite what Mr. Bill Morneau might be doing here in March moving forward with, trying to do the alleged 30-year amortization for first-time buyers, that's not necessarily going to influence the banks. The banks ultimately will decide what they want to lend and whom they want to lend to. And so I think that's something worth keeping an eye on and worth considering. I would also note that I think what is arguably a bombshell report here today is the Q4 GDP for Canada. Wow. There's not really any way to say it, but just a complete disappointment to the downside. Naturally, of course, the headline that came out that was circulating that I had a good chuckle on was Canadian GDP stagnates, or I was thinking it's Canadian GDP flatlines. And nobody saw it coming. Nobody saw it coming. We've been talking about this in these weekly videos here for nearly 6 months now. All you had to do was watch the pace of household credit growth. Household credit growth is what drives demand. The rate of change in credit growth not only spurs into unemployment, the rate of employment, but also into wage growth and the demand for housing. And so right now what we see is you have household credit, year over year as of December, growing at its slowest pace since June of 1983. That's that is historical by all standards. And so what you have here is you have an extremely leveraged household sector that has driven the economy for arguably the past 2 decades, and now you are restricting that credit. Households are so indebted that any sort of further stimulus towards the household sector is akin to pushing on a string. And so all you had to do was look at the level of household credit growth to determine that this economy was heading for a serious slowdown. And housing, which follows the rate of household credit growth, is again arguably leading indicators for where the economy is going, particularly when the Canadian economy is particularly built up on housing and on residential construction. So the Canadian economy slowed for, it's now declined for 3 of the past 4 months. Canadian GDP has declined 3 of the past 4 months. Annualized GDP came in at 0.4%. The expectations by mainstream economists, and I believe the Bank of Canada was for 1% GDP growth. So you have a huge miss. And then these economists yet are still calling for rate hikes in 2019. I think it was Scotiabank. So I get all these reports. So I get forwarded every bank's. As soon as these sort of GDP figures come out, I get sent all their reports. So I got RBC, Scotia, BMO, TD. So I get to read what every single economist puts out there to their investment base, and it's always just interesting to sort of see how these guys are thinking. And some of them I think I would certainly agree with, and some of them I think are way off base. I think I was reading Scotiabank, and they said, oh yes, this GDP disappointed. Q1 will probably disappoint, but by Q2, Bank of Canada will be back on a rate hiking path. And there's nothing here in the data that spells rate hike. As I've said before, that the next move is almost certainly going to be a rate cut when GDP contracts for 3 of the past 4 months. And this is a housing-led recession that is consumer-driven. You had, let's look at my notes here. You had construction GDP for construction sector declined for the last 7 consecutive months. 7 consecutive months GDP contracted. Household residential investment contracted, I believe, year over year by 14.5%. And this is coming off a low base. So what we can see here is a comparison of residential investment as a percentage of GDP compared to Canada and the US. As you can see here, the differentiator fact is that the US went through a deleveraging period in the household and real estate sector in 2008, 2009. And so their investment into real estate declined significantly, whereas the Canadians, we continue to increase that investment, and a lot of that GDP growth has continued to drive through household and real estate investment. And so, as you can see, is basically this is coming off a very high base, and so now we're starting to see, and that's why I think the U.S. economy I'm much more bullish on. I think that they've gone through their serious deleveraging phase. I think their households are in a much stronger position. Their debt service ratios have stabilized at a very low base, whereas the debt service ratios now in Canadian households is the highest it's been in 10 years. So you have 2 completely different economies, 2 completely different household sectors between Canada and the US today. And so just to see these GDP numbers come out, the only reason GDP would have been arguably negative on an annualized basis if it wasn't for a significant buildup in inventories. And this buildup in inventories is basically companies front-running trade negotiations, etc. So you can expect those inventories to actually drop off in Q1. So you'll almost certainly see a more continued negative print in GDP. So by that definition, you could very well be in a recession by Q2 2019 from a technical basis. So and a recession is defined as 2 consecutive quarters of negative GDP. So that's where we're at today. Again, not really surprised. I think the main factor is just to continue to watch housing and to continue to watch the household credit growth sector, and that will basically tell you where we're going. Looking at construction declining, 7 consecutive months GDP, what we have to do is you can dial that back into a more micro aspect and look at Vancouver single-family housing starts. So Greater Vancouver single-family housing starts from their peak have now dropped 15%. And this is a result. Single-family housing starts can adjust much quicker than multifamily construction starts. Generally, multifamily, there's a very long building permit process. There's a very long capital investment process where generally, as soon as they get that process going, they want to get their shovel in the ground ASAP, almost regardless of the market conditions. Whereas a single-family builder, it's a much different capital structure, and they can pivot with the market much quicker. So you have started to see construction start to drop off in terms of housing starts for condo developments. I think those are going to drop significantly, as I've talked about, because the pre-sale absorption rate has really dried up as we're seeing sales really start to slow, not only in Vancouver but Toronto as well, which is your largest Canadian real estate market. New home sales in Toronto for 2018 were at an 18-year low. So as developers struggle with their pre-sale sales targets, as they struggle to hit the number of pre-sales required in order to obtain construction financing, you'll see housing starts drop off significantly, and that will only further weigh on GDP, construction, residential investment, which will only further slow down the economy and the knock-on effects of that. We've already seen a significant slowdown in the consumer spending, retail spending, etc. And so again, it's just important to understand all these knock-on effects. But again, we're looking at Vancouver dialing it back. The February numbers are, for the most part, officially out. I've preliminarily released them on my Twitter feed. I'm going to do a video next week doing a deep dive on the Vancouver housing market, the stats for February. But preliminarily, as I can tell you, the trend is continuing. There is no Chinese New Year bounce. There is no change in the direction of credit. As I mentioned, it will continue to get tighter. Again, if this data starts to change, then I will change my opinion with that. I think as the data changes, you have to continuously update your framework and your thesis. But it's just been a continuation of all the data that has filtered through. Everything is falling into place. And so, despite media reports suggesting that things were going to stabilize, or you're going to spring bounce, or Chinese New Year is going to, pump the market, condo sales for Greater Vancouver came in February at a 10-year low for the month. So it was the fewest condo sales since February 2009, just post-financial crisis. Detached single-family home sales in Greater Vancouver came in at the weakest home sales on record. As far as my data goes back to 1992, it was the fewest detached single-family homes in Greater Vancouver, dating back to 1992. Again, that's as far as my data goes back. So I would argue that the market could turn around tomorrow, hypothetically, and I would argue that we've already lived or experienced a historical correction in the housing market that was once perceived as unthinkable. If you had gone back 2 years ago and told people that in 2 years' time, Vancouver will suffer the fewest single-family home sales ever. Again, probably dating back to the 80s if we go and pull that data, but Mine only goes back to 92. If you had told people 2 years ago that you will go through the steepest drop ever in single-family home sales, I think people would have called you crazy. I think even if you were, again, to say condo sales would fall to a 10-year low, that would just be complete blasphemy. But this is the ultimate situation that we're in. So again, the market could turn tomorrow. That's not where I'm putting my money. I don't think that that's going to transpire, but again, we'll watch the incoming data. But this has already transpired. So the whole objective of these videos is to continue to provide an unobjective view of the market. We are data dependent here. As the data changes, I will change. But this is the reality of the situation. So as I've said, price declines are already baked in, just the way that the data is reported, similar to the way that the sales declines are likely to be reported. I suspect that March condo sales will be worse than a decade low, primarily because the comparative base analysis that you're comparing sales to, i.e., you're going to start comparing March 2019 sales to all the other March years, and March of 2009 really wasn't that bad because we had begun to come out of the minor little recession that we had here in Canada, where home sales in March 2009 actually started to pick up. So now when we start to compare March 2019 sales, we'll be comparing against a base that really isn't that bad. So, and I'll continue to monitor, obviously, how is the real estate board going to, and how is the media going to report the performance of home sales here. There's really no positive way to announce these sales other than you had a month-over-month increase, which is really just a seasonal increase. The sales increase month over month from January to February to March to April to usually to May, and then they usually peak out and then they slow down as you enter the summer months. So again, that's where we are today. This is not something I think to be worried about. As I've said, nothing grows to the sky. Recessions are inevitable. Housing slowdowns are inevitable. You have we had the Chinese demand in 2015 and 2016, which helped propel the market. Domestic credit, as a result, increased significantly as locals, tried to keep up with that inflow of Chinese capital. And then as a result, that propelled the economy, propelled housing starts, accelerated GDP, and now you have the Chinese capital, which has contracted. You have domestic credit shrinking, and then as a result, you now have construction slowing, and that all plays on it. And as we can see, retail spending slowing as well. So everything has a knock-on effect, and this is clearly what we're seeing in the data. So we'll continue to be data dependent here moving forward. Otherwise, hope that helped. See you next week.